Define and state the purposes of bank reconciliation. Bank reconciliation is the process of comparing and matching the balances recorded in a company's accounting records with the balances shown on its bank statement. It is an important accounting practice that helps ensure the accuracy and reliability of a company's financial information. During bank reconciliation, the company's internal records, such as the general ledger and cash book, are compared to the bank statement to identify any discrepancies between the two sets of records. These discrepancies can arise due to various reasons, such as timing differences, errors, or outstanding checks or deposits. The main goal of bank reconciliation is to ensure that the ending balance of the company's cash account in its accounting records matches the ending balance shown on the bank statement. The process involves reviewing and comparing individual transactions, including deposits, withdrawals, checks issued, electronic transfers, service charges, and any other bank-related transactions.